It's time to talk about technical analysis. Now, please don't turn off your television sets. It's not as scary as you'd think. In fact, it's probably easier to apply than fundamental analysis. The problem is getting over our fear of charts and things our high school teachers made us hate when we were young. The reason technical analysis is simpler is because in financial markets, we're looking at numbers. Now, although the language of economic announcements and news seems easier to understand, taking all those words and converting them into numbers is something that the best mathematical minds are still trying to do. In technical analysis, there's no conversion. It's numbers talking about numbers. The reason it works is because those numbers translate human behavior into trends. They do the work for us. Now, the main aim of technical analysis is to identify past patterns and predict future patterns upon them. And since human behavior has been subject to the same instincts since time began, it's not so far-fetched to predict that past behavior is a fair indication of future behavior. If falling markets caused panic in 1929 and 2008, there's no reason to suppose that the same human animal will suddenly be complacent about losing all its savings in the future. As a matter of fact, and as we'll see further on in this course, one of the most reliable technical indexes ever created is based on Elliott waves. Elliott waves identify the same basic patterns over different time frames, from minutes to centuries. And as a result, if you're looking at a chart and fail to see a pattern, zoom in or zoom out, and chances are you'll soon find one. Prices rising and falling as trends, consolidating before reversing, and even giving useful hints whenever they diverge from their moving average. They'll march between the price that the masses think are too high and too low, redirect indecision, become volatile when volume is low, and stable when liquidity rises. They'll retrace after a strong movement as traders take profits on successful investments. Charles Dow is considered the father of modern-day technical analysis. During the second half of the 19th century, he found time to create the Dow Jones Company. That's the one that publishes the famous Dow Jones Index. He also created the Wall Street Journal, which is still considered the world's leading business newspaper. Dow was basically a journalist with very little formal education. He wrote about history and found his way into business reporting by interviewing bankers and businessmen. His words about silver mining still echo as a warning on nearly every site and prospectus in the business. Buy nothing without careful, thorough investigation, and don't risk more than you can afford to lose. In 1896, the Dow Jones Company published the first stock index, and not long before his death, his friend Sam Nelson published a book summing up his 250 editorials for the Wall Street Journal. The result was the 6 rules of financial markets, sometimes referred to as Dow's theory. First, the market has 3 movements: main, medium, which is a 33 to 66 retracement, and short. 2. Market trends have 3 phases: accumulation, motivated by those in the know; absorption, for those who try to catch up; and distribution, which accompanies speculation. 3. The market discounts all news, since market action reflects the reaction to the news. And unfortunately, this one only works in a completely efficient market, which is rare. 4. Market averages must confirm each other. Again, this works only in a well-integrated market where sectors are interrelated. 5. Trends are confirmed by volume. What this means is simply that the higher the trading volume, the truer the trend. And finally, 6. Trends exist until signals prove their culmination. Or, if you like, there's always going to be a trend. And if there isn't, there will always be a movement to the next one. So, let's begin.